This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice. Welcome to the Luxembourg Fundcast.
Today we're jumping into something quite specific, a strategy called the reverse takeover, or RTO.
Right, and we're looking at it through a very particular lens based on materials you've shared. What happens when the target of this RTO is a publicly traded investment fund right here in Luxembourg?
Exactly. We've got a good set of sources, different documents and research focusing on this niche. Our job is to unpack it all.
Yes, our mission today is to work through these sources, pull out the most important stuff, and really get a handle on what an RTO is, why a private company might target a public fund like this, and importantly, what it means for the existing shareholders of that fund. Getting you up to speed quickly on a fairly complex topic using the info provided.
We'll cover the legal mechanics under Luxembourg law, the step-by-step, the shareholder impact, the regulator's role, the CSSF, and even the tax side. All based on these materials.
Okay, let's dive in. First things first. What is a reverse takeover? The name itself sounds a bit backwards.
It is intentionally so. Fundamentally, as the sources explain, an RTO is a method for a private company to become publicly listed without going through the whole traditional initial public offering, the IPO route.
Right, the big public launch. So instead of selling shares to the public that way, How does it work?
Well, instead, they arrange for an existing publicly listed company, often a smaller one, to technically acquire them. But here's the reverse twist. The shareholders of the private company swap their shares for shares in the public company. And they get so many new shares that they end up owning a controlling stake in that public entity.
Okay, I think I'm getting it. So the public company is the legal acquirer on paper.
Right.
But the real control, the business itself, effectively flows from the private company into that public vehicle.
Exactly. The public entity is often called a shell. Maybe it has minimal operations or its market value is much smaller than the private company coming in. An RTO flips the usual takeover script where big buys small. Here, the smaller public company acts as the legal doorway for the private owners to get onto the public market and take charge.
Okay, so how is this different from, say, a standard IPO or just a regular merger?
Good question, and the sources make this distinction clear. Unlike a typical IPO, where the main goal is usually to raise significant new capital.
Right, selling shares for cash.
The primary driver for an RTO is often simply getting that public listing, achieving the status of being publicly traded. Raising capital might come later, but it's not usually the first step.
So maybe it's faster, cheaper than a full IPO.
Speed is definitely highlighted in the sources as a potential major benefit. An RTO might get done in, say, a few months. An IPO with all the regulatory hoops, underwriting, roadshows, that can easily take a year, maybe more.
And you avoid market timing risk, perhaps?
That's a big part of it, yeah. You avoid that long exposure where market downturns could scuttle the whole IPO plan. Though the sources do note RTOs don't usually generate the same buzz or initial investor rush as a big IPO.
Makes sense. And compared to a standard merger?
In a standard merger, the shareholders of the company doing the buying typically keep control. But in an RTO, the structure is specifically designed so that control shifts. It moves to the shareholders of the company that was legally acquired, the owners of the former private business. That change in control is really the defining feature.
Got it. A strategic path to public listing via acquisition. Now let's focus on Luxembourg. Why do this here? And specifically, why target a Luxembourg fund as the public shell?
Well, the core reasons for doing an RTO are those potential advantages we mentioned. Speed, maybe some cost effectiveness compared to an IPO, and that certainty of getting listed without being at the mercy of market windows for too long.
But why a fund structure? Are they just convenient shells lying around?
Not exactly just convenience. The sources point out that certain Luxembourg fund types are actually quite strategic choices. We're talking about structures like a SICAV.
Okay, that's the Société d'Investissement à Capital Variable, the open-ended investment company.
Right, or a SCAR, the Société d'Investissement à Capital Risque for venture capital. Or even a CIF, the Fonds d'Investissement Spécialisé, the specialized investment fund.
What makes those suitable RTO targets?
Often, these funds are set up as a Société Anonyme, an SA. That's basically Luxembourg's public limited company structure. So you've got that corporate form, plus they're already regulated investment vehicles. That combination can make them pretty ideal public shells.
How so?
Well, they already have a listing on a regulated stock market. Their shares trade publicly. They have an existing corporate governance framework in place. They have audited financials. They have a shareholder base.
So they're not just empty legal boxes. They come with existing infrastructure.
Precisely. And sometimes their assets, usually portfolios of securities, can be easier to manage or integrate after the RTO compared to, say, absorbing a complex manufacturing business with factories and supply chains.
The sources used an interesting phrase, a high-quality shell. What's the significance of that?
Yes. This really gets to the heart of why using a regulated Luxembourg fund is strategically smart. You see, RTOs sometimes carry a bit of a stigma, right? Maybe seen as a backdoor listing for companies that couldn't quite cut it for a traditional IPO.
Mm-hmm. A perception issue.
Exactly. But if you use a regulated Luxembourg fund as your vehicle, one that's already supervised by the CSSF,
The Commission de Surveillance du Secteur Financier, the main regulator.
right. That supervision really helps counter any negative perception. You're using a vehicle that's already part of a well-respected regulatory system.
So it lends credibility, legitimacy.
Absolutely. You're leveraging Luxembourg's reputation as a major financial center. This fund already has CSSF oversight, probably a history of clean audits, established governance, compliance procedures. It adds a significant layer of credibility right from the start. The sources even call it a strategic branding exercise, using the fund's regulated status to boost the image and appeal of the newly public company for the market, for future investors. It's not just any shell, it's a reputable one.
That makes a lot of sense. Offers a built-in level of trust.
It's a key advantage of this specific approach.
Okay, concept clear, strategy clear. Let's dig into the legal framework. How is an RTO actually structured under Luxembourg law?
Based on the materials provided, the most common and legally efficient route here is a merger by absorption. In Luxembourg legal terms, that's fusion par absorption.
Merger by absorption. So the public fund legally swallows the private company.
That's the structure, yes. The public fund is the absorbing company, and the private business being acquired is the absorbed company. The really key legal effect here, driven by Luxembourg's main company law, the Law of 10, August 1915, on commercial companies, usually just called the 1915 law, is something called Transmission Universelle de Patrimoine.
Universal transfer of patrimony. Sounds very comprehensive, like everything just shifts over automatically.
Pretty much, yes. By operation of law, all the assets, all the liabilities, everything owned and owed by the absorbed private company automatically transfers to the absorbing public fund. And the absorbed company, it simply dissolves as part of the process. No need for a separate liquidation. It's a very clean legal transfer.
Okay, and how does the control actually change hands within that legal framework?
That happens simultaneously through the share exchange. The shareholders of the private company being absorbed don't get cash. Instead, they receive new shares issued by the absorbing public fund. The number of shares they get is determined by a pre-agreed share exchange ratio, the rapport d'échange.
Right, the ratio that determines how many fund shares they get for their private company shares. And they get enough to take control.
Precisely. This compulsory swap of shares is the legal mechanism that puts the former private company owners in the driver's seat of the public fund, making them the new majority. The 1915 law has specific rules governing this whole merger process.
Are there alternative legal structures mentioned?
The sources briefly mention another possibility, though maybe less common for absorbing a whole operating business: a contribution in kind or a port on nature. Here, the private company shareholders would contribute their shares directly into the fund in return for new fund shares.
How's that different?
It's governed by slightly different articles in the 1915 law, and it specifically requires a report from an independent auditor on the value of the contributed shares and the terms of the new fund shares being issued. But generally, the merger by absorption is seen as more suitable for this kind of RTO, and it's the main focus in our sources.
Okay, merger by absorption it is. Let's walk through the practical steps. How does this unfold phase by phase?
Right, the sources break it down pretty clearly. It starts with phase A, the preparatory phase. Think of this as laying all the groundwork.
Who's running the show at this stage?
It's primarily driven by the management bodies, usually the boards of directors of both the public fund and the private company. They work very closely with their teams of external advisors, legal teams for the complex drafting, financial advisors for valuation and deal structure, tax advisors, and a really key independent player enters the picture early on, the independent statutory auditor, the reviseur d'entreprise, who has a critical reporting role later.
Lots of expertise needed right out of the gate. What's step one?
Typically, it kicks off with negotiation and agreeing on a term sheet. This is where they hash out the core commercial terms, how the private company is valued, the likely share exchange ratio, who will be on the new board, any major deal conditions. It's usually captured in a non-binding document, like a heads of terms or letter of intent.
Okay, initial handshake on the main points. Then comes the deep dive.
Absolutely. Due diligence. This is non-negotiable and usually very thorough. The public fund, with its advisors, investigates everything about the private company, financials, legal standing, contracts, operations, potential hidden liabilities.
Why is that so critical from the fund's perspective?
Well, the fund's board owes a duty to its existing shareholders. They need to know exactly what business and what risks they're bringing into the fund. You need to uncover any skeletons in the closet before the deal closes, not after. The sources really emphasize how exhaustive this process needs to be.
I bet. And that diligence feeds directly into the next big piece, valuation and setting that share exchange ratio, right?
Yes. This is often the most commercially sensitive and, frankly, the most negotiated part. Agreeing on a fair value for the private company is absolutely fundamental because that value directly drives the share exchange ratio.
How do they land on a value?
The sources mention the usual methodologies, things like discounted cash flow, DCF analysis, projecting future earnings and discounting them back. Market-based approaches comparing the company to similar listed companies or recent comparable deals. Maybe some asset-based methods, but often less relevant for operating businesses. Ultimately, the valuation and that crucial exchange ratio are the result of hard negotiation.
Because that ratio determines the split. How much of the combined company the original fund shareholders keep versus how much the new owners get.
Exactly that. It directly translates the private company's value into the percentage of control the new owners will get in the public fund. And of course, it dictates the level of dilution for the original shareholders.
So all this groundwork, negotiation, diligence, valuation, it all leads to a central legal document.
Correct. The main legal output of this phase is the draft merger plan, the projet de fusion. This is drafted jointly by the management of both companies. And under the 1915 law, this draft plan isn't just an internal document. It must be filed with the Luxembourg Trade and Companies Register, the RCS, and then published in the official electronic gazette, the RESA, Recueil électronique des sociétés et associations.
Is there a specific timing for that publication?
Yes, a critical one. It has to be published in the RESA at least 1 month before the shareholder meetings are held to vote on the merger. That 1-month gap is designed to give shareholders time to digest the proposal.
And the law is specific about what must be in that plan.
Very specific, yes. The 1915 law mandates certain contents for transparency and shareholder protection. It has to include details like the legal form, name, registered office of both companies. Critically, it must state the proposed share exchange ratio. It also has to mention any small supplementary cash payment, which by law can't be more than 10% of the nominal value of the new shares issued.
So cash is really just a minor top-up, if anything.
Right. The main consideration is shares. The plan also needs to detail how the new shares will be allotted, the effective accounting date for the merger, any special rights for specific security holders in the private company, and any special perks or advantages being given to management or the experts involved. The law demands this detail.
Okay, that's the plan itself. Are there other key reports shareholders need to see?
Yes, absolutely critical reports for informing the shareholders. First, there's the management report. The boards of both companies have to write a detailed report explaining the legal and economic reasons for the merger and specifically justifying the proposed share exchange ratio.
Is that report always required? Seems fundamental.
It basically is, in practice. The 1915 law has a provision allowing it to be waived, but only if there's unanimous agreement from shareholders across all merging companies. For a public fund with many shareholders, getting everyone to agree unanimously is virtually impossible. So effectively, yes, it's mandatory.
And the other big one comes from an independent expert.
Yes, and this is arguably the most crucial piece of independent assurance for the public fund's original shareholders. One or more independent experts who must be approved statutory auditors, réviseurs d'entreprise agréés, are appointed specifically to examine the draft merger plan.
What's their job exactly?
Their report must state clearly whether, in their professional opinion, the proposed share exchange ratio is fair and reasonable. They also have to describe the valuation methods they used and say if those methods were appropriate for these specific companies. Like the management report, this independent expert report is mandatory for a public fund RTO because you just can't get that unanimous waiver.
So that expert opinion on fairness, it heavily influences how shareholders will vote.
It's absolutely pivotal. It gives shareholders an objective, professional assessment of the deal's core economic term. A clean fairness opinion really helps sell the deal. If the expert raises concerns about fairness, that could make it extremely difficult to get the necessary shareholder approval.
Right, that makes sense. Okay, that covers the prep work. Let's move to phase B, the transactional phase. This is where the deal actually gets approved and legally sealed. Who are the key players now?
The ultimate power now shifts to the shareholders of both companies. They make the final decision. Also playing crucial roles are the Luxembourg notary, who authenticates the legal resolutions, and the RCS again, for the official filings and publication that make it binding.
And it all hinges on shareholder meetings.
Correct. Both companies must hold extraordinary general meetings, or EGMs, the main agenda item, voting on the draft merger plan. Calling these meetings has to follow the strict rules in the 1915 law and the company's own articles. And remember, these meetings cannot happen less than that crucial 1 month after the plan was published in the RESA.
That 1 month, that's the window for shareholders to get informed.
Exactly. Luxembourg law gives shareholders strong information rights. For at least 1 month before the EGM, they have the right to go to the company's registered office and inspect all the key documents. The draft merger plan, the last 3 years of accounts and reports, and, critically, those management and independent expert reports we just discussed. It's all about enabling an informed vote.
Okay, then the vote itself. What are the hurdles for a public fund, typically an SA?
Approving a merger is a big deal legally, treated like amending the company's fundamental articles. So the 1915 law sets high thresholds for an SA.
What are they voting on, specifically? One single resolution?
Yes, typically it's a single vote covering everything. Approving the merger plan, approving the merger itself, approving the universal transfer of assets, and approving the necessary increase in the fund's share capital to issue the new shares.
And the voting majority needed, is it just over 50%?
No, it's much higher. It's a supermajority. First, for the meeting to even be valid, the quorum, shareholders representing at least half of the total share capital must be present or represented. Then, to pass the resolution, you need at least 2/3 of the votes actually cast by those present or represented shareholders.
Half the capital to show up, and then 2/3 of those votes to approve. That sounds significant.
It is. And if you don't meet that initial 50% quorum at the first meeting, you can call a second EGM. At the second meeting, there's no quorum needed. Any number of shareholders can vote. But you still need that 2/3 majority of the votes cast at that second meeting to get it approved.
That 2/3 requirement seems like a really important protection for the original shareholders.
It is. It's one of their primary legal safeguards. It means a group holding just over 1/3 of the voting shares can actually block the whole deal. It acts as a direct check, forcing the deal proponents, the private company, and the fund's board to propose terms, especially that exchange ratio, that are genuinely seen as fair enough to win over a broad supermajority, not just scrape by with 51%.
So it puts real pressure on making the deal attractive, considering that expert report, too.
Exactly. You have to convince a substantial majority that this is a good deal, or at least not a bad one for them.
Okay, let's assume they get the 2/3 vote. What's next legally?
The EGM resolutions approving the merger must be formally recorded in an authentic notarial deed. The Luxembourg notary is essential here. They don't just witness signatures. They legally verify that the whole process, including the EGM conduct and voting, complied with the 1915 law. The sources also note that for cross-border mergers under the EU Mobility Directive, the notary now has an expanded role checking for potential abusive practices.
Once the notary signs off.
The notary executes the deed. It's then filed with the RCS and officially published in the RESA. That publication is the moment the merger becomes legally effective and enforceable against everyone else, like creditors.
And the fund's own documents get updated.
Yes, definitely. The fund's articles of association are amended to reflect the huge capital increase from issuing all those new shares, and the fund's shareholder register is updated. The original shareholders are still there, with fewer percentage points, and the new majority owners are added. If the fund had bearer shares, this update happens via the official register kept by the depositary.
So that EGM vote needing 2/3 is really the key moment where original shareholders collectively wield their power over the deal's fate.
It's the core democratic mechanism, ensuring they have a real say and can stop a transaction they feel is unfair.
Which brings us neatly to phase C, the shareholding impact. We keep mentioning dilution. Let's unpack what that really means for those original fund shareholders.
Right. Dilution is the most direct, unavoidable consequence for them. It simply means their percentage ownership of the company, and therefore their share of the voting rights, gets smaller because a large number of new shares have been issued to someone else here, the former private company owners.
And in an RTO, this isn't some unwanted side effect. It's the whole point, right? It's how control transfers.
Exactly. The deal is structured precisely so that the private company owners receive a big enough block of new shares to dilute the original holders down to a minority position.
Can you use that example from the sources again, just to make it concrete?
Sure. Let's say the public fund started with 10 million shares outstanding, owned 100% by the original investors. In the RTO, to reflect the value of the private company being absorbed, the fund issues maybe 90 million new shares to that company's owners.
Yeah.
So after the deal, the fund has 100 million shares total.
Okay.
The original shareholders still hold their 10 million shares. But now those 10 million shares represent only 10%, 100 meters of the bigger company, down from 100% before.
Wow. Yeah, that really shows the scale of the shift.
Yeah.
They keep the same number of shares, but their slice of the pie and their voting power shrinks dramatically.
Precisely. Now, their economic value per share might hold up, or even increase, if the combined business is worth much more. But their proportional ownership and control are fundamentally reduced. That said, even with this dilution, Luxembourg law and practice offer several important protections for these original shareholders who now find themselves in the minority.
What are those key safeguards?
Well, first, and we've hit this point hard, is the emphasis on a fair exchange ratio backed by independent valuation. That mandatory report from the independent expert confirming the ratio is fair and reasonable is designed to ensure that even as percentage ownership drops, the underlying economic value represented by their shares is protected or hopefully enhanced by the merger.
So the goal is economic fairness, even if the percentage goes down.
That's the idea. Second, there's that powerful supermajority shareholder approval requirement. Needing that 2/3 vote at the EGM under the 1915 law gives the original shareholders real collective power. They can band together and legally block the deal if they feel the terms are unfair or the dilution just isn't justified economically.
So if enough of them think it's a bad deal, they just vote no and stop it dead.
Yes. If shareholders holding just over 1/3 of the voting power object, the merger can't proceed. That forces the acquirer to offer terms that are likely to get broad support. Third, there's a more recent, quite powerful protection, especially if the RTO involves a company from another EU country, a cross-border merger. This comes from the statutory exit rights introduced by the EU's Mobility Directive, now part of Luxembourg law.
Exit rights, what does that mean?
It means any shareholder who formally votes against the merger resolution at the EGM gets a legal right to demand that the absorbing company, the fund, buys back their shares for fair cash compensation.
Hang on. So if I'm an original shareholder, I don't like the deal, I vote against it, I can force them to pay me cash for my shares?
That's essentially it. It's a very strong right. It makes shareholder dissent potentially expensive for the company pushing the deal. If they think many shareholders might vote no and demand cash, it gives them a strong incentive to offer fair terms in the first place to minimize those costly redemptions.
That definitely adds pressure on the deal makers to keep shareholders happy. Any other protections mentioned?
The sources briefly touch on potential contractual anti-dilution rights. These might be found in specific agreements with, say, large institutional investors who negotiated things like preemptive rights to buy more shares in future issuances to maintain their stake. But these are less common for the average shareholder in a widely held public fund and are more specific arrangements. The statutory protections are the main ones for most.
Okay. So dilution is inherent, but there are these layers: fair value checks, the supermajority vote, potential cash exit rights designed to protect the original shareholders' interests and give them a real voice.
That's the balance the system tries to strike, yes, facilitating the strategic transaction while safeguarding existing investors.
Right. The deal's done, control has shifted. Let's talk phase D, the post-merger world. What's the typical next move for the new majority owner?
Often, the new controlling shareholder, the group that came from the private company, wants to consolidate fully and get to 100% ownership. Having minority shareholders, especially in a listed company, means ongoing reporting, administrative complexity, maybe limits on strategic moves. Full ownership simplifies everything.
Makes sense. How do they achieve that last bit of ownership, force the remaining minority out?
Yes, Luxembourg has specific laws for this, mainly the Law of July 2012, on mandatory squeeze-out and sell-out. And it's important, as the sources note, that these rights under the 2012 law are separate from any squeeze-out rights that might apply after a formal public takeover bid under the different takeover law. This 2012 law provides standalone mechanisms.
Okay, so this 2012 law covers both squeezing out and selling out.
Correct. The mandatory squeeze-out, or retrait obligatoire, is a right for the dominant shareholder. If someone, or a group acting together, gets to own at least 95% of the company's share capital and 95% of the voting rights, they can legally force all the remaining minority shareholders to sell their shares to them.
That's the path to 100% and the sellout.
That's the mandatory sellout, rachat obligatoire. This is a protection for the minority. If a majority owner crosses a slightly lower threshold holding more than 90% of the voting rights, then any leftover minority shareholder gets the right to demand that the majority holder buys their shares, again, at a fair price.
So the sellout stops minority holders from being stuck in a company totally dominated by one owner with no way out.
Exactly. It guarantees them a fair exit if control becomes that concentrated, preventing them from being trapped in an illiquid position.
Let's focus on the squeeze out. Since they're forcing people to sell, I assume the process is tightly controlled for fairness.
Extremely. The procedure is regulated to protect the minority. First, the dominant shareholder, the one with 95% plus, must officially notify the CSSF they intend to do a squeeze out. They have to provide proof they meet the thresholds and state the fair price they're offering.
And who decides if the price is actually fair?
This is critical and involves CSSF oversight. The dominant shareholder needs to back up their proposed price with an independent expert valuation report similar to the one needed for the merger itself.
Yeah.
This report goes to the CSSF for review, and the CSSF's role is key. They have to be satisfied that the price offered is genuinely fair and equitable to the minority shareholders being pushed out.
So the regulator acts as a check on the price determination.
A crucial check, yes. Once the CSSF gives the green light on the price, the company has to publicly publish the terms and the squeeze-out offer.
And then the shares change hands.
Yes. The transfer of shares from the minority to the majority holder and the payment are then carried out, all under the general supervision of the CSSF. The sources mentioned a real example involving Saucy IFI SA shares in August 2024, where the CSSF oversaw this exact process under the 2012 law.
Those percentages, 90%, 95%, seem really important. Can you quickly recap the key ownership thresholds mentioned?
Sure. The sources flag these critical levels. Hitting 33.3% of voting rights in a listed company usually triggers an obligation to make a mandatory public takeover bid under the takeover law. Getting more than 90% of voting rights triggers the minority's mandatory sellout. Right under the 2012 squeeze-out law, they can force the majority to buy them out. And holding at least 95% of both capital and voting rights gives the majority holder the mandatory squeeze-out. Right under that same 2012 law, they can force the minority to sell to them.
Okay, those are the key legal triggers for consolidation and minority rights after the main deal.
They define the endgame possibilities and protections, absolutely.
Right, we've covered the structure, the process, the shareholder impact. What about the practical side? Costs, pricing, timeline. This sounds like an expensive and time-consuming exercise.
Oh, it definitely requires significant resources, both time and money. Generally, the expectation is that the acquiring private company, the one driving the RTO, bears most of the costs.
What are the main cost buckets we're talking about?
The biggest chunk, almost always, is advisory fees. You've got lawyers handling complex corporate law, regulatory filings, contracts. You have financial M&A advisors for strategy, negotiation, execution, valuation experts figuring out the fair price, auditors checking financials and reports, tax advisors making sure the structure is efficient. These fees add up.
The notary's involved too, right?
Yes, there are mandatory notary fees for preparing and executing that official merger deed. Then you have regulatory and filing fees paid to CSSF for their review and authorization, and fees to the RCS for the various filings and publications required by law.
What about taxes on the transaction itself in Luxembourg?
Generally, Luxembourg is quite favorable here. Transaction taxes are usually minimal. The actual share transfer is typically exempt from registration duty and VAT. And critically, the merger itself can often be structured to be tax neutral at the company level if certain legal conditions are met. This means the fund doesn't pay immediate tax on the assets it absorbs. The tax is deferred. The sources mentioned a very small nominal fixed registration duty, just 75 euros for the notarial deed itself.
That tax neutrality sounds like a big plus.
That's a significant advantage, yes. It avoids creating a huge tax bill just from doing the restructuring.
Any other costs to budget for?
Sometimes parties agree on breakage fees. These are pre-agreed payments if the deal falls apart for specific reasons. It's basically compensation for the time and money spent getting that far.
We talked about valuation being key, but how does that translate into the price paid, practically speaking?
Well, the price in an RTO isn't usually a cash figure for the whole company. It's fundamentally expressed in that share exchange ratio. That ratio is the price that reflects the negotiated relative values of the public fund shell and the private business coming in. And as we've stressed, the independent expert's report provides that crucial check on whether this negotiated price is fair.
Okay, lastly, time. How long does this whole RTO process take, realistically?
It varies, of course, depending on how complex the private business is, but the sources give a pretty good indication based on the phases. Host speaker, lay it out for us. Phase 1. Prep, due diligence, documentation. This is all the upfront work. Negotiations, the deep dive investigation, drafting the merger plan, getting the management and expert reports ready. This can easily take 2 to 4 months, maybe longer if the target company is very complex.
Okay, a few months of intense work just to get the paperwork ready, then getting approvals.
Phase 2. Regulatory filing and shareholder approval. This part is driven a lot by legal waiting periods. Remember that 1-month publication requirement before the EGMs. Factoring in calling the meetings, holding them, maybe needing a second meeting. This phase typically takes 1 to 2 months. It also includes informal chats and formal submissions to the CSSF.
And finally, closing the deal and maybe cleaning up the share register.
Phase 3. Closing and post-merger consolidation. Once the shareholders approve and the notary deed is done, the legal closing of the merger itself can be quite quick. But if the new owner wants to do that squeeze out to get to 100%, that adds another step with its own procedures under the 2012 law. That can take an extra 1 to 3 months, including the CSSF notification and price review.
So adding all that up, what's a realistic ballpark from start to finish, including a potential squeeze out?
Based on the sources, you're probably looking at a total timeline of somewhere between 4 and 9 months, roughly. That's assuming things go relatively smoothly, without major unexpected roadblocks.
Still potentially quicker than the year or more for a complex IPO we talked about earlier.
It often is, yes. That speed can still be a key attraction, although, as we'll discuss, the regulatory landscape is getting busier, which could affect future timelines.
You've mentioned the CSSF multiple times. Let's really focus on their role. They sound like the ultimate gatekeeper when a regulated fund is involved.
They absolutely are. The CSSF, the Commission de Surveillance du Secteur Financier, isn't just rubber stamping the legal paperwork. Their involvement is deep, it's substantive, and it's essential for the deal to happen.
What's their main objective or mandate here?
It's broad. It goes beyond just checking boxes on corporate law compliance. They're concerned with the overall stability and integrity of Luxembourg's financial sector, and critically, with investor protection. That's a huge focus in an RTO involving a public fund.
So you need 2 green lights, one from the shareholders under company law and one from the regulator.
Precisely. It's a dual-track approval process. The RTO has to satisfy the 1915 law requirements, ending with that shareholder vote. And it needs the CSSF's authorization under their supervisory powers. Fail on either track, and the deal stops. That's why early and transparent communication with the CSSF is so important throughout the process.
Where does the CSSF really dig in? What are their key areas of review?
Several critical points. First, they heavily scrutinize the change of control itself through the approval of new qualifying shareholders. Since the RTO brings new owners into control of a regulated entity, the CSSF performs a fit and proper assessment. They look at the new controller's professional background, their reputation, financial health, integrity. Are they suitable people to run a regulated entity? This includes a very strict check on potential money laundering or terrorist financing risks, MLFT risks.
So they vet the new people in charge.
Thoroughly. They need to be satisfied. These new owners meet Luxembourg's high standards. Second, the CSSF provides the formal authorization for the merger itself. Any merger involving a regulated fund, like a UCITES, SIF, SICAR, needs prior CSSF approval. They review the merger plan, the expert's fairness opinion, all the documents, checking for fairness to minority holders and compliance with fund-specific laws and CSSF circulars.
So they're looking at the same core documents as the shareholders, but with a regulatory focus.
Exactly, with that investor protection compliance lens. Third, a major piece is the review and approval of the prospectus. An RTO fundamentally changes the fund, its strategy, assets, now including the private business, risks, management, everything. The fund's prospectus, the key document for investors, has to be completely rewritten. That revised prospectus needs formal CSSF review and approval of Visa before it can be used. The sources mentioned a new electronic e-identification system for this since April 2025.
Good to see modernization. What about the AML-CFT side?
AML-CFT scrutiny, anti-money laundering, and counter-terrorist financing is extremely high priority. The parties have to submit a detailed AML-CFT market entry form via the CSSF's online portal, eDesk. This requires full disclosure on the new ownership structure, the source of funds behind the deal, even though it's a share swap, and importantly, the ultimate beneficial owners, the UBOs, of the acquiring structure.
Why such intense focus there?
It's fundamental to protecting the integrity of Luxembourg's financial system, preventing it from being misused for illicit purposes. The CSSF is very rigorous here. Fifth, if a squeeze-out happens later, the CSSF directly supervises the squeeze-out process. As we covered, they get notified, review the thresholds, critically review the fair price offer based on the expert report, check the shareholder communication, and oversee the execution.
And after everything is done,
The newly combined entity, if it remains a regulated fund or even just a listed company, continues under the CSSF's ongoing supervision. It's subject to all the usual continuous reporting, governance, risk management, and compliance rules that apply.
wow. So the CSSF is involved from vetting the new owners, authorizing the deal, approving the investor documents, checking AML, overseeing the final cleanup, and then supervising going forward. They're really central.
Absolutely central. They're the regulatory backbone ensuring these complex deals meet Luxembourg's standards for investor protection and market integrity.
Okay, let's switch to tax. How do the tax implications shape an RTO involving a Luxembourg fund?
Tax is always critical, right? It affects the real bottom line outcome. Generally, Luxembourg's tax rules are quite favorable for this kind of restructuring, often aiming for tax neutrality. But planning is key.
How does that neutrality work for the fund entity itself?
The major benefit is the potential for a tax-neutral merger. Under specific conditions in Lux tax law, mirroring the EU merger directive, the absorbing fund usually doesn't have to recognize an immediate taxable gain on the assets and liabilities it gets from the absorbed company. Those assets typically roll over at their existing tax book value. The catch: this deferral usually requires that Luxembourg keeps the right to tax any future gains on those assets, which often means the absorbed business operations need to continue as a permanent establishment of the fund within Luxembourg.
So the tax isn't wiped out, just pushed down the road until maybe the fund sells those assets later.
Exactly, at the entity level. And for ongoing tax, most regulated funds in Luxembourg UCI, CIFs, CCARs, has a special status. They're exempt from corporate income tax, business tax, net wealth tax. Instead, they pay an annual subscription tax, the taxe d'abonnement, on their net asset value. The standard rate is low, 0.05% per year, sometimes even lower at 0.01% for certain funds. After the RTO, this tax just applies to the new, larger asset base.
What about the shareholders? They're swapping shares, which sounds like a taxable event.
It is technically a disposal, but crucially, both Luxembourg tax law and the EU merger directive provide for tax deferral on the capital gains for the shareholders involved in the share-for-share exchange.
How does that deferral work for them?
Basically, any profit they might have made on paper from swapping their old shares for new ones isn't taxed at the time of the merger. The tax is deferred. For tax purposes, the new shares they receive in the public fund inherit the acquisition cost and date of their old shares. Tax only becomes due if and when they eventually sell those new shares down the line.
That's huge. No immediate tax hit from the transaction itself. What about international investors holding shares in the fund?
This is a big part of Luxembourg's appeal as a fund center. Generally, non-resident investors are not subject to Luxembourg capital gains tax when they sell shares in a Luxembourg fund. There's a narrow exception for selling a significant participation, more than 10%, within 6 months of acquiring it. But even then, double tax treaties often give the taxing rights solely to the investor's home country, meaning no tax in Luxembourg anyway.
So it sounds pretty tax efficient overall for the fund and the shareholders, especially cross-border ones. Are there any nasty surprises or tax traps to watch out for?
Yes, the sources flag one important potential issue, particularly if the fund vehicle used is structured as a tax-transparent partnership, like the very popular Société en Commandite Spéciale, or SCSP. This involves the reverse hybrid mismatch rules.
Reverse hybrid mismatch sounds complex. What's the risk?
These rules come from the EU's Anti-Tax Avoidance Directive, ATAD. They can kick in when you have entities treated differently for tax in different countries. If an SCSP, which is tax transparent in Luxembourg, has investors, say, 50% or more based in countries that treat the SCSP as opaque, taxable entity, then Luxembourg law might step in and tax the SCSP itself on the income linked to those specific investors. This effectively flips the intended tax transparency for that part of the income.
Whoa. So the tax treatment could change based on where the new controlling investors are from and how their countries view the SCSP.
Precisely. That's why thorough tax due diligence on the new controlling shareholder's tax status is absolutely vital when using transparent structures like an SCSP for an RTO. You need to understand if these reverse hybrid rules could be triggered and potentially create an unexpected corporate tax liability for the fund itself.
So the tax framework is helpful, generally neutral, but you definitely need experts to navigate it correctly and avoid traps like those hybrid rules.
That sums it up well. Tax planning is not an afterthought, it's integral.
Okay, last section. Let's look to the future. The sources mention the legal and regulatory scene isn't static. What changes are coming that could affect RTOs in Luxembourg?
Things are definitely evolving. The sources highlight one particularly significant development.
Which is?
The expected introduction, likely in 2025, of Bill of Law number 8296. This bill is set to create Luxembourg's first ever comprehensive national merger control regime.
Luxembourg didn't have its own merger control before this, only EU level.
That's right. Competition reviews only happened at the EU level if deals were big enough to meet those thresholds. This new law introduces mandatory ex ante, meaning before the deal closes, national control. Mergers, acquisitions, certain joint ventures hitting specific turnover thresholds linked to Luxembourg will have to be notified to the Luxembourg Competition Authority before they can be implemented.
And that would apply to RTOs if they hit the thresholds.
Yes. It introduces a standstill obligation. You legally can't close the RTO until you get clearance from the Competition Authority. This adds a whole new regulatory hurdle, potentially impacting timelines and adding complexity.
So could that potentially erode the speed advantage RTOs sometimes hold over IPOs?
It certainly could add delays that weren't there before. It's a major change to factor into future deal planning. And beyond that specific Luxembourg law, there's the ongoing stream of EU regulatory integration. New directives and regulations keep coming. Things like the Retail Investment Strategy, RIS, focusing on investor protection, new tax transparency rules under D8 amendments like DZ8 for crypto, corporate sustainability rules like the Corporate Sustainability Due Diligence Directive, CSDDD. These all add more disclosure and compliance work for public companies, including those created via an RTO.
So just generally more compliance obligations for the company after the RTO is done.
Exactly. It's part of a broader trend affecting all public companies and financial entities, making ongoing operations more complex and potentially costlier.
Given all this, what's the outlook for RTOs using Luxembourg funds? Still a viable strategy?
The sources suggest yes, RTOs will likely remain a relevant alternative to IPOs, especially when markets are choppy, and getting a listing done with certainty is key. And using a regulated Luxembourg fund still offers that strategic quality shell advantage we discussed. But the increasing regulatory load, especially the new national merger control and EU rules, might well temper those traditional speed and cost benefits somewhat.
Which really underscores the need for top-notch advisors.
Absolutely. Pulling off a successful RTO into a Luxembourg fund is going to require even more meticulous planning and really specialized legal, financial, and tax advice to navigate that increasingly complex mix of corporate law, fund regulation, competition law, and tax.
Wow. Okay, that was a truly deep dive.
Huh.
We've really unpacked the reverse takeover process, defining it, understanding the strategy for using a Lux fund, walking through the legal steps, seeing the shareholder impact, appreciating the CSSF's critical role, and considering the tax angles, all based on the sources you brought.
Yeah, we covered a lot. The importance of that fair exchange ratio, the power of the two-thirds shareholder vote, the CSSF as the gatekeeper, and just how crucial careful planning is given all the intersecting rules.
So whether you're listening because you're involved in a deal like this or you're just trying to stay current on sophisticated finance in the fund space, hopefully understanding these different layers drawn from these materials helps you feel much better informed.
It really shows how specific legal and regulatory features of a place like Luxembourg can be used strategically in finance.
Definitely. And it leaves us with a really interesting question to think about, doesn't it? With that new national merger control coming in 2025, potentially slowing things down, will the main appeal of an RTO remain its speed compared to an IPO? Or will the focus shift even more towards the strategic value, the benefit of gaining a public listing through a highly regulated, credible vehicle like a Luxembourg fund, even if it takes a bit longer? Something to watch as the landscape keeps evolving.
This podcast contains content generated or significantly edited using artificial intelligence tools. All information is provided for general informational purposes only and reflects knowledge available at the time of publication. It does not constitute financial, investment, or legal advice. We recommend that listeners verify the information independently and consult with qualified professionals for personalized advice.
Hit that like and subscribe button. It was the Luxembourg Fundcast for you today.